Ladies and gentlemen, welcome back to another gripping episode of Boss Economics World, where deep dives into economic trends take a satirical turn, and we do what the policymakers should be doing, but clearly aren't. Today, we're looking at the murky waters churning beneath global trade and geopolitics, taking us uncomfortably close to an economic sinkhole. Buckle up, because between the ongoing war in Ukraine, the relentless and messy US-China trade war, and Trump's bombshell proposals for a tariff bloodbath, it looks like we are headed for a slow but sure rupture of international economic relations. Let's get one thing straight. We are not talking about progress. The world economy is no longer charging forward with the perfect efficiency of globalization that marked the late 20th century. No, we are now in an era of slowbalization, an awkward limbo where the global economy stumbles along with incrementally slower growth, increasing debt overheads, and gnawing distrust between global power blocks. Yes, globalization isn't dead quite yet, but it's marred with fractured relations between countries, hasty policy shifts, and heightened uncertainty. First, let's talk about the elephant in the room, the war ongoing in Ukraine and the US-China trade tussles. These events seem to have set the tone for the coming decade. Whether it's Donald Trump promising to slap unprecedented 60% tariffs on China's exports, or his pledge to yank away U.S. security guarantees from nations that don't pay their dues, we're looking at a major decoupling of economies, with ramifications that would echo through our entire global finance system. According to Bloomberg Economics, if these geopolitical tensions continue escalating, the economic ramifications would be chilling. In the second Cold War scenario, $7.1 trillion could evaporate from global GDP by 2035 compared to today's already slowbalized, low-growth baseline. The crazy part is this is not merely theoretical pessimism. Thanks to the Goldberg pool models used for the analysis, high-quality economic projection tools, there's good reason to be scared. Now, let's break this down into bite-sized chunks. Don't worry. I've done the homework the world's policymakers seem too distracted to finish. So what does slowbalization, or worse, a rapidly emerging two-block Cold War-like world, actually mean for our wallets, investment portfolios, debt levels, and daily economic activities? Our current low-gear economic state, slowbalization, is sold as the most likely scenario. Growth continues, albeit limping along at a weak 3.3% average for the next decade. Compare that with the 3.7% we enjoyed before COVID-19 hit. Even China's miracle economy, which soared at 7.7% before the pandemic, is struggling to reorient in this slow-growth era with projections falling to 3.7% for the next decade. The U.S. fares no better, with its growth rate decelerating to an anemic 1.7% from 2.4% pre-pandemic. Those percentages might not seem like much, but in the world of macroeconomics, that discrepancy will hit growth, jobs, wages, and ultimately, your bank account balance. Debt looks even more concerning. Global debt-to-GDP ratios are set for intense ballooning. Debt for the G7 economies is expected to inflate from 126% in 2023 to a bloated 142% by 2035. The United States, always leading the pack in something, right? We'll see debt rise from 97% of GDP in 2023 to a dizzying 139% by 2035. That's a steady ticket to fiscal imbalance and lower credit ratings, which ultimately risks sparking more debt crises around the corner. It leaves future policymakers increasingly starved of the flexibility they need to manage policy. And guess what? All of this happens while we enjoy a low-conflict, low-tension environment compared to the Cold War-esque alternatives that could come. At this rate, even China, perceived as a rising hegemon for decades, will face similarly stark realities. Its debt will surge from 56% to 88% of GDP, another sign that for all its rhetoric about global dominance, the underlying fundamentals in China aren't as strong as either Beijing or doomsaying Western hawks like to claim. But hold on to your hats, folks. We haven't even delved into the nightmare option yet. Imagine a world splintered into U.S. and China-led spheres, with tariffs reaching stratospheric highs of 40%. Welcome to Cold War 2.0, a reality that seems all too plausible, at least according to projections. In this dismal configuration, migration between countries dwindles to almost zero, trade links snap, and major restrictions throttle cross-border investments. And it's not just developing countries that will be left to scramble in the dirt for scraps. You'll witness advanced economies struggling too. Global growth under this Cold War 2.0 scenario would slow to a mere 2.9%. Let's put that in perspective. By 2035, the world economy will be $7 trillion smaller than under the already sluggish Slowbalization outlook. The U.S. economy alone would bleed a painful $500 billion from its projected GDP by 2035 due to this slowdown, while China, facing the curse of its poorly aging population and increased capital flows frictions, loses about $2.5 trillion. Crucial productivity gains get left on the operating table as essential global trade and capital flows come to a screeching halt. The global corporate world, with some of its largest firms dependent on the efficient, globalized supply chains we've relied on for decades, will be scrambling to reconfigure production. Remember the disastrous 2021 microchip shortage that crippled industries like auto manufacturing worldwide? That will seem like child's play compared to what could happen when large swaths of international manufacturing links are severed due to protectionist policies and protracted conflicts. But, it doesn't stop there. Defense spending skyrockets almost uniformly as hawkish governments compete in a game of Cold War prestige. Governments in G7 economies will raise military expenditures from 2.3% of GDP in 2023 to 4%, all in the name of security. Call that a steep price for peace if you must, but it's going to come with higher taxes and lower civil spending. Why does this matter? Because higher defense spending happens at the expense of productive investments in education, healthcare, and innovation, the cornerstones of sustainable long-term growth. Thus the debt, the debt. U.S. debt, as mentioned, skyrockets to nearly 150% of its GDP. Can you imagine living in a world where the global economic hegemon is teetering at the edge of solvency? Even mighty China won't be immune to fiscal carnage, with its debt-to-GDP ratio ballooning to 118%. Say goodbye to fiscal flexibility, and hello to the perpetual risk of currency wars, bond volatility, and inflation fluctuations. And that's on a good day. With all these seemingly high-level issues hitting debt, growth, and geopolitical dynamics, let's zoom in a bit. What does all this mean for you? You, the everyday citizen, the investor, the professional, or even the good old saver who just wants a solid retirement fund in 30 years. Let me paint a picture. In a world where globalization reverses, you'll be paying hefty premiums for goods previously sourced easily from far-flung coordinates. Think of the steady prices of tech gadgets, cars, or even basic goods like clothing under global trade. You'll watch them skyrocket as import taxes drive prices through the roof. Inflation, already a nasty companion from the post-pandemic hangover, will climb higher. And forget about safe, stable investments. Markets will get riskier as countries within trade blocs decouple, leading to volatile financial systems. And for the workforce, let's just say that mobility will be reduced. Immigration flows, which once added vitality to aging economies, will come to a virtual standstill. Fewer migrants will mean fewer consumers, fewer entrepreneurs, fewer new ideas to foster productivity. And speaking of labor markets, what happens in the US and other advanced economies? They'll see serious productivity bottlenecks. Technology transfers between countries dwindle, and critical talent no longer flows smoothly between borders. All those international conferences that incubated invention and discovery, well, you can solely rely on your own block now for better or worse. Now a quick aside about Mr. Trump 2.0, or more precisely, the horrors of Smoot-Hawley 2.0. The 1930 Smoot-Hawley Tariff Act led to retaliatory rounds of global tariff hikes that deepened the Great Depression. Trump's proposed 60% tariffs on China, and his barely veiled threats of doing the same for Europe, Japan, and anyone else caught in his crosshairs, come dangerously close to repeating history's mistakes. And let me be frank, history is not something we can afford to repeat. This kind of protectionism would make prices exorbitantly high and completely obliterate the gains we've made through lower trade barriers over the last 70 years. While the most distressing possibilities loom large, there is a glimmer of hope, a scenario in which calm heads prevail, and the global economy steps back from the precipice of protectionism. Imagine a world where, by some miracle of political foresight, US-China tariffs are rolled back to pre-trade war levels, maybe even back to the glorious early 2000s when the Doha round of tariff reductions kick-started a revival in global trade. Granted, the likelihood of this new golden age is slim at best, but stranger things have happened. Yes, we've acknowledged that, in the short term, Washington's appetite for free trade is about as healthy as a kid's appetite for broccoli, but make no mistake, political winds can change. What happens in this globalist fantasy? Growth ticks up slightly, with the global economy expanding at about 3.4% per year through 2035. The U.S. manages to squeeze out some extra productivity, with GDP growth creeping up to 1.8%, thanks to both reduced trade barriers and resumed capital flows. China, which would likely gain even more from eliminating the suffocating tariffs imposed in the Trump years, could see growth rebound to 4%. That's no small feat, and in pure dollar terms, we're talking about a whopping $800 billion boost to China's GDP by 2035. Debt, too, while still a bear to manage, doesn't spiral out of control as badly. With a slightly more buoyant economy, governments can focus less on piling up defense expenditures and more on addressing real, structural weaknesses in their budgets. U.S. debt stays bad, but not apocalyptic. Debt to GDP ratios would remain on a knife's edge but avoid tipping over into unsustainable territory, a problem that's hard to fix but better than full collapse. This scenario, what we might call neo-globalism light, also halts the breakdown of highly productive networks built by decades of integration. Think about the advances in technology, education, and healthcare that global cooperation has nurtured. These benefits don't get flushed away in a zero-sum game of escalating tariffs. Capital investments and partnerships across borders would remain viable again, a safeguard for the international business ecosystem that relies on it. The stock market wouldn't be the daily rollercoaster ride professed by rabid protectionists, leaving investors with fewer sleepless nights and potentially more stable long-term returns. Yes, I can hear your skeptical chuckles and murmurings already, but Xiao Cui, we know this isn't happening. We know protectionism is politically popular. Trump bulldozed the globalist consensus in 2016, and Washington hasn't been the same since. And you're absolutely right. Whether it's Trump's America First, Brexit's nationalist tendencies, or China's increasing self-reliance, the momentum for cooperation is faltering. No one seems eager to return to the 1990s heyday of globalization. The old neoliberal consensus, free trade, open borders, less regulation, isn't quite dead, but it's on life support with little hope for a full revival. Just look at the 2024 U.S. election landscape. Bloomberg rightly points out that, regardless of whether we're facing a second Trump presidency or Kamala Harris, or another centrist Democrat, noticing the wins in Washington, free trade doesn't seem to offer the votes it once did. Sure, there might not be 60% tariffs on China with a Harris administration, but there also won't be any rush to the past. Washington is treating China like an adversary, not a market opportunity, and that isn't changing anytime soon. So where does that leave us? Here's the kicker. The most likely outcome over the next decade and beyond isn't a return to the sunny uplands of boundless global trade, nor is it the brutal second Cold War scenario that would see the world divide into rigidly controlled blocks. It's what we're already living in. Slowbalization. Let's call it what it is, a crawl, not a sprint. Protectionist policies aren't strong enough to blow up the global trading system entirely. They're more like a chronic illness we've yet to find the cure for. And yes, while that might keep the economic engine running, it's going to feel distinctly underwhelming. The big, ambitious infrastructure upgrade you were planning may now take an extra 5 years to accomplish due to supply delays and higher costs. The shiny tech future prophesied by the Silicon Valley giants will roll out more slowly, with innovation impeded by retracted knowledge exchange and fractured investment flows. The emerging contradictions? Those lucky few countries and companies fortunate enough to be within America or China's circles might fare relatively well. China's expanding Belt and Road Initiative, BRI, could still fuel growth for many developing countries aligned with it, while powerful firms in the US and EU might adapt to more protectionism by consolidating monopolies and playing with bigger government contracts. The rest of the world? The economic ladder is going to get even harder to climb as labor mobility declines, restricting access to new opportunities. From an investor's perspective, there are advantages, but you'll have to dig deep. In this fractured world, national champions will dominate key industries. Think big tech, aerospace, defense, and even agriculture. Governments leaning heavily on industrial policy are likely to spur artificially created winners. But the downside? Larger companies get protected, while small and medium enterprises, SMEs, get starved of resources and attention. Emerging markets, particularly those caught outside the key power blocks, face the most peril. They've been the biggest beneficiaries of globalization, using access to technology, capital, and broader markets to fuel rapid growth over the last few decades. In a slowbalized world, these countries will struggle. Brazil, India, and South Africa, for instance, will need to navigate this jagged landscape, deciding which block they align with for maximum growth and minimal political fallout. And let's not forget the growing markets in Asia and Africa that are desperate for inward investment and technology. Already cut off from the most advanced technologies under export controls, many of these aspiring economies will play catch-up with hand-me-downs from richer nations, a digital economy built on legacy tech. Savvy investors might find opportunities in sectors like green energy or mobile banking, where big leaps can happen with basic infrastructure, but these success stories won't entirely offset the productivity losses elsewhere. Expect inflation to be a persistent problem. Between the dismantling of global supply chains, protectionist policies, and higher defense expenditures, price pressures across the globe will likely stick around. Already, we're witnessing inflation settling comfortably above central bank targets post-pandemic, and with protectionism rearing its head, this won't be a temporary glitch. Add to that the effects of climate change disrupting supply chains, food prices, and migration patterns, you have the recipe for sustained volatility in prices. Just think of shifting energy policies and their impact on your utility bills. Yes, that green energy transition is crucial, but it's not guaranteed to be cheap or smooth. Here comes the doomsday scenario. Even if we avoid a full Cold War II breakdown, we could be staring down the barrel of sustained stagflation, a nasty combination of stagnating growth and persistently high inflation. The last time the world saw this was in the 1970s, when geopolitical conflicts, oil embargo, collided with slow productivity growth and high prices. That wasn't fun then, and it won't be fun now. Stagflation marks one of the worst environments for policymakers to wrangle with. Why? Because traditional tools don't work as well. Try to stimulate growth with lower interest rates. They may spur inflation even more if supply chains remain choked. Try to control inflation by cutting demand, and watch jobs and wages shrink, sending the economy into an even deeper rut. It's the Schrodinger's cat of economic challenges. Do something, and it's worse. Do nothing, and, you guessed it, it's also worse. Let's be brutally honest. The U.S., as much as any other country, is guilty of fueling this slow-motion disaster. Its shift away from the role of global economic leadership, from trade wars, export bans, and protectionism to pressuring its allies and friendly countries to curb collaboration with China, has set the tone for much of this current mess. And here's the kicker. Even if President Trump doesn't come back in 2024, it's questionable whether the main pillars of the U.S.'s defensive economic posture, particularly regarding China, will change. There will be no rapid restoration of global trust, because part of the damage is embedded within the structure of modern geopolitics itself. For investors, policymakers, and everyday citizens alike, the conclusion is clear. We are in for at least a decade of slower growth, higher debt, unstable supply chains, and likely persistent price volatility. As much as we may long for the high-octane growth of yesteryear's globalization, that world isn't coming back. It's a reality we must labor within and adapt to, shrewdly, cautiously, and with our eyes wide open to the complex, fractured horizons ahead. Thank you for watching, my friends. If you haven't already, hit that subscribe button and turn on notifications. You're going to want to stay tuned as I guide you through the uncertain financial weather ahead. I'll be back soon to deliver more economic truths, and likely point out a few more governmental missteps along the way.